Despite all the speculation of an upcoming financial crisis, the dollar continues to rise. But experts like Jim Rickards caution that the situation could turn into a massive recession. Former lawyer turned economist Jim Rickards has warned against the Fed's actions, stating that they might drive the economy into a great catastrophe. Jim Rickards is a well-known investor worth $19 million, with an estimated $4 million of his annual income coming from various ventures. We've covered Jim Rickards and his view on inflation in a previous video, and today, we will be getting an updated perspective on inflation and the Fed's policies against it. Make sure you watch until the end so you can prepare your portfolio against the upcoming financial crisis. Thanks for all the support you've shown our channel. Let's dive right into the video.
There is a demand for dollars somewhere around the world to buy that really good collateral because it looks like a safe haven relative to everything else that's falling apart. That's not exactly what's going on today, but it's related. We're not in a global financial panic right now. We may be heading for one. We talked about that separately. We're not in one right now. We are in a recession. It looks the U.S. is definitely in a recession right now. We had 2 consecutive quarters of decline in GDP, first quarter, second quarter. Well, that's a recession. We'll see what the third quarter is going to be, but it may be prolonged. It may get worse. Europe is in a recession, based on the latest data. Japan is in a recession. China looks like they're in a recession. They reported their most recent growth figures of 0.4% for the second quarter, not 4%, but 0.4%. Versus compound growth of over 10% for about 30 years. So, and they lie. So if they're admitting 0.4, then I have to believe that's negative. So we're really looking at a global recession. Now, a recession or even a depression, which it may turn into, is not the same as a financial panic. You can have panics without recessions. We saw that in 1998, 1987. You can have recessions without panics. We saw that in 1990 and 2020. Sometimes they do go together. 2008 was an example of both a severe recession and a severe financial panic. But I would keep those separate because if we're not in a global financial panic, then we don't necessarily have dollar buying because of get me out of everything else. Although I want to come back to that. But we are in a recession. The recession should damp down the inflation. It hasn't yet. Inflation's high. There's no question about it. We see it in the data.
Jim Rickards starts off by clarifying that the US is not in a financial panic, but instead, the US is in a recession reflected by their declining GDP for the past 2 quarters of this year. Jim Rickards also states that there is a difference between a recession and financial panics. He adds that one may exist without the other, or they could exist together. Jim Rickards adds that this recession is expected to lower inflation, as he explains in this next clip.
That may trend a lot lower very quickly, but not for good reasons. In other words, you say, well, what's the Fed doing about inflation? Well, they really can't do anything about it. The inflation is coming from the supply side. The inflation can come from probably a lot of places, but 2 places in particular, supply side and the demand side. Supply side inflation is when there are shortages, there are bottlenecks, there's supply chain dysfunction, people run out of stuff, there's not enough fertilizer, not enough water, not enough truck drivers, ports are clogged, you can't get the input A to make item B, so you got to shut down assembly line because you can't get titanium from Russia to build Boeing aircraft. It's complex, it's huge. It's the subject of my next book, Sold Out, which is coming out in November. But supply chains are breaking down in many different respects, and prices go up as a result. But that's not, but the other kind of inflation is called, and that's called cost push inflation. The other kind of inflation is demand pull inflation. This is when consumers change their behavior. They get it in their heads like, hey, prices are going up, they're getting out of control. I better go out and buy that thing, and this is what we lived through in the 1970s. And I remember very well, if you were going to buy a refrigerator, a new car, a dishwasher, whatever, you'd say to yourself, I better go buy it today, because if I wait 3 months, it's going to be higher. or 6 months, it's going to be a lot higher. So, of course, that just pulls demand forward and it creates excess demand relative to supply. And then prices do go up and it feeds on itself. Next thing you know, bosses are handing out raises because of inflation, people just spend more, et cetera. The Fed can do something about demand pull inflation. They can destroy demand by raising interest rates, raising mortgage rates, credit card rates, and everything else. They can't do anything about supply inflation, the supply chain inflation, cost push inflation. They can't do anything about it. The Fed doesn't drill for oil. The Fed doesn't drive a truck. The Fed doesn't run a cargo line. The Fed doesn't mine, titanium in Russia. They can't do anything about any of those things. And then you get into, is it really inflation? Well, inflation means prices are going up. But if they're going up for that reason, two things are true. One, the Fed can't do anything about it. Two, it will probably run its own course in the sense that, if prices go higher, there's going to be a lot less discretionary income. You still got to put gas in your car and you still got to put food on the table. If those two things have doubled in price, and they have, then you have that much less left over for everything else. You'll say, well, I'm going to skip the vacation, skip the concert, skip the restaurant, skip a lot of things, new furniture, whatever. I'm not going to buy any of those things because all my money is going to buy gas and food. You still get the gas and food, but not more. You just pay more. And the value of your dollar goes down, real wages go down, and you're not spending money on anything else. That'll put the economy in a recession real fast. That's happening. We're in a recession. I already said that, but it will get worse. Now, here comes the Fed, right? Always a day late and a dollar short, or maybe too many dollars, but they always get it wrong, is my point. So what are they doing? Well, they're saying inflation in the numbers. They don't really seem to distinguish between supply side and demand side. And they're going to the Volcker playbook, raise rates, raise them. That can get inflation under control, but only at the cost of a much worse recession, higher unemployment, business failures, people out of work. I say, who cares what the price of gas is if you're sitting home unemployed?
Jim Rickards states that the Fed cannot do anything about inflation because this inflation roots from supply issues. Jim Rickards briefly explains that supply issues are issues within the supply chain, such as shortages or barriers within the supply chain itself. This is known as cost-push inflation. Another type of inflation is demand-pull inflation, which according to Jim is caused by consumer sentiment. When consumers expedite their purchases due to fear of soaring prices, it creates an excess of demand and demand surpasses supply. Prices then go up as a result. Jim says that the Fed can affect demand pull inflation by destroying the demand with high interest rates, credit card rates, and more. However, they can't do anything about cost push inflation or issues within the supply line. Jim Rickards concludes by saying that two things are true about the current inflation situation. First is the Fed is powerless and cannot do anything about it. Second is that it will run its own course no matter what anyone does. As prices go up, consumer spending will come down, as will wages, which will cause a recession, and what Jim Rickards believes is happening today. Lastly, Jim Rickards says that raising interest rates to control inflation will work, but it will result in a much worse recession. In this interview, Jim Rickards stated that he believes that the US is in a recession. This claim is backed up by previous declining GDP data from the US. Lastly, Jim Rickards states that the Fed's decision to continue to raise interest rates will only make it worse for the economy. Jim says that although this may control inflation in the short term, the long term will result in a much more devastating recession. How do you think the next few months will play out for the US economy? Do you believe that the Fed is making the wrong move by raising interest rates? Give us your thoughts in the comments section down below. If you enjoyed this video, kindly like and subscribe, and we'll catch you on the next one.